Margaret is 74 years old. She lives in Pennsylvania. Her daughter Claire is 46, recently divorced, and raising 2 teenagers on her own. Claire lost half the household income when the marriage ended. She is behind on her mortgage. She is stressed. She is struggling. Margaret has a retirement account. She has a brokerage with stock she has owned since the 1990s. She has a house worth $420,000 that she paid $75,000 for in 1988. She loves her daughter. She wants to help. So she does what any mother would do. She calls her accountant and asks what she is allowed to give. Her accountant tells her about the annual gift exclusion. He says the IRS allows you to give up to $19,000 per person per year completely tax-free. No forms, no returns, no reporting. Margaret asks if there are any other limits. Her accountant says the lifetime exemption is $15 million. He says she has nothing to worry about. Margaret walks away from that conversation feeling like she has been given a green light. She writes Claire a check for $19,000. She transfers stock worth $22,000 into Claire's brokerage account the following year. She deeds a piece of land she owns into Claire's name because she thinks it will make it easier to pass things along. The IRS never calls. No penalties, no letters, no forms required. Margaret assumes she did everything right. 2 years later, Margaret has a fall that leads to a series of complications. She needs assisted living. Then she needs a nursing home. Her savings are moving faster than she expected. She applies for Medicaid to help cover the costs. The state pulls 5 years of her financial records. Every bank statement, every brokerage transaction, every deed transfer. They find the $19,000 check. They find the stock transfer. They find the land deed. All of it inside the 60-month look-back window. The state calculates a penalty period. Margaret is ineligible for Medicaid coverage for months. She is in a nursing home. She has no assets left. Claire cannot return the money. The stock was sold to cover the divorce costs. The land is now in Claire's name, and Claire's mortgage lender has a claim on it. The IRS told Margaret everything was fine. The IRS was right. Medicaid operates under a completely different set of rules, and nobody told Margaret. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional and a licensed elder law attorney before making any decisions about your specific situation. My name is Kevin with Kevin Retirement Strategy. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I am going to show you exactly what the IRS $19,000 rule actually is, why it is one of the most misunderstood rules in all of retirement planning, and why following it correctly does not protect you from the consequences most retirees never see coming. I'm going to walk you through the Medicaid trap that turns legal gifts into Medicaid disqualifications. I'm going to explain the capital gains mistake that costs children tens of thousands of dollars in taxes on gifts their parents thought were tax-free. I am going to show you the stepped-up basis rule that most families are unknowingly giving up when they try to be generous. And I am going to give you a specific action checklist so you know exactly what to do and what to stop doing before you transfer another dollar to any family member. Most of what I am about to cover is not explained in a single conversation by anyone. Your accountant may know the gift tax rules, your financial advisor may know about capital gains, but the place where these rules collide with each other and with Medicaid is where real families lose real money, and almost nobody explains that intersection before a decision is made that cannot be reversed. Let me start with the rule itself, because most retirees only know part of it. The IRS annual gift tax exclusion in 2026 is $19,000 per recipient. That means you can give up to $19,000 to any individual person in a single calendar year without filing any gift tax return. You do not report it. You do not track it. You owe nothing. A married couple can give $38,000 per year to a single recipient because each spouse has their own $19,000 exclusion. You can give $19,000 to each of your children, each of your grandchildren, and as many individuals as you want. There is no limit on the number of recipients. There is only a per-recipient annual cap. If you give more than $19,000 to a single person in one calendar year, you file IRS Form 709 with your tax return. Filing Form 709 does not mean you owe gift tax. It means you are reducing your lifetime gift and estate tax exemption by the amount above the annual exclusion. In 2026, the lifetime exemption is $15 million per individual, approximately $30 million for a married couple. That number was made permanent under the One Big Beautiful Bill Act. Nearly every American can give away $15 million over an entire lifetime before a single dollar of actual gift tax is owed. There are 2 additional exclusions that go beyond the $19,000 limit entirely. Direct tuition payments made directly to a qualifying educational institution are completely excluded from gift tax with no dollar cap. Direct medical payments made directly to a healthcare provider for another person's care are completely excluded from gift tax with no dollar cap. Neither of these requires Form 709. Neither counts against your annual exclusion or your lifetime exemption, so the IRS framework is genuinely generous. Give under $19,000 per person per year and file nothing. Give more and simply report it to reduce a $15 million exemption most people will never come close to reaching. Give directly to schools and doctors, and there is no limit at all. This is where most retirees stop asking questions. The IRS says it is fine, the accountant confirms it, the conversation ends. And that is exactly where the trap begins. Medicaid is not the IRS. This sentence is the most important thing in this video. Medicaid is a joint federal and state program that covers long-term care costs, including nursing home care, assisted living in many states, and home health aid services for people who meet income and asset requirements. When you apply for Medicaid long-term care benefits, the program conducts a detailed financial review of the 60 months immediately preceding your application date. 5 full years. Every bank account, every investment account, every deed transfer, every check written to a family member, every asset transferred for less than fair market value, every single financial transaction is reviewed. And here is the rule that changes everything. Under Medicaid, any transfer of assets for less than fair market value during the look-back window creates a penalty period. The Medicaid system does not recognize the IRS annual gift exclusion. A gift of $1,000 can trigger a Medicaid penalty just as certainly as a gift of $100,000. Filing Form 709 provides zero protection. Owing no gift tax provides zero protection. Having your accountant confirm the IRS rules were followed provides zero protection. The only thing Medicaid reviews is whether money or assets left your control within the 5-year window. The penalty is calculated precisely. Take the total dollar value of all gifts and transfers made within the look-back period. Divide that number by the average daily cost of nursing home care in your state. This daily rate is called the penalty divisor, and it varies by state. In a state where the daily rate is $300, a $30,000 gift creates a 100-day penalty period. The resulting number is the number of days you are ineligible for Medicaid benefits, and the penalty period does not begin on the day you made the gift. The clock does not start when the transfer happened. The clock starts on the day you apply for Medicaid after spending down your other assets. That sequencing is critical. You give away money. You spend down the rest of your savings on care. You apply for Medicaid with nothing left, and only then does the penalty period begin. You are in a nursing home with no money and no coverage. This is not an edge case. According to the Department of Health and Human Services, approximately 70% of people turning 65 today will need some form of long-term care during their lifetime. More than 40% will spend time in a nursing home. The median annual cost of a private room in a nursing home in the United States has crossed $100,000. Medicare covers skilled nursing care for up to 100 days under very specific conditions following a qualifying hospital stay. After day 100, Medicare stops. For most retirees who need extended care, Medicaid is the only program that covers it, and Medicaid reviews every gift you made in the last 5 years. That is the conflict at the center of this video. The IRS says the $19,000 rule allows free giving. Medicaid says every gift within 5 years can delay your coverage. The capital gains rules add a third layer that catches families even when they navigate the first two correctly. Let me walk you through 3 specific situations so you can see exactly how this plays out in real families. Patricia is 69. She has 4 grandchildren. Each year at Christmas, she gives each one $4,000. 4 grandchildren times $4,000 is $16,000 per year. She is well under the annual exclusion. She files no returns. She owes no gift tax. She has been doing this for 6 years and never thought twice about it. At 71, Patricia is diagnosed with a condition that requires placement in a memory care facility. She applies for Medicaid after depleting most of her savings on 2 years of private care. The state reviews 5 years of bank records. They find 60 months of grandchild gifts totaling $80,000 within the look-back window. All of it is within the IRS annual exclusion. All of it creates a Medicaid penalty period. Patricia's attorney explains that the IRS gift limit and the Medicaid gift limit are 2 entirely separate systems with no connection to each other. Patricia's family is left managing a significant penalty period they never anticipated because nobody had that conversation before the gifts were made. Gerald is 71. He owns a rental property he purchased in 1992 for $55,000. It is worth $310,000 today. His son Daniel is buying a home and needs help with a down payment. Gerald decides to deed the property to Daniel to help him get started. Gerald is not selling it. He is giving it to his son. He checks with his accountant. The property value exceeds the annual exclusion, so he files Form 709. No gift tax owed because he is well under the $15 million lifetime threshold. Gerald believes the transaction is handled correctly from a tax standpoint. 18 months later, Gerald has a cardiac event that leads to a long-term care need. He applies for Medicaid. The property transfer is in the look-back window. The state values the transfer at $310,000, the fair market value at the time of the deed. The penalty period calculated from that transfer is significant. Gerald has no property and limited savings. He is waiting for a penalty period to end while nursing home invoices accumulate. Gerald also handed his son a problem he never intended to create. Daniel now owns a property with a cost basis of $55,000, the price Gerald paid in 1992. When Daniel eventually sells that property, he owes capital gains tax on the difference between $55,000 and whatever the sales price is. If the property sells for $310,000, Daniel owes capital gains tax on $255,000. If Gerald had kept the property and left it to Daniel through his estate, Daniel would have received a stepped-up basis equal to the fair market value at the date of Gerald's death. Daniel could have sold the property and potentially owed nothing in capital gains. Gerald gave his son a property and a capital gains tax bill. He intended to give security. He created a liability on two separate levels simultaneously. Susan is 72. She has a brokerage account containing stock she purchased in 2001 for $18,000. The stock is now worth $85,000. Her daughter is going through a difficult period financially and Susan wants to help. She transfers the stock into her daughter's account. The transfer value is under the annual exclusion limit. No Form 709 required. Susan believes the gift is clean. Her daughter now owns stock with a cost basis of $18,000. When the daughter sells it, she owes capital gains tax on $67,000 of appreciation. At the 15% federal long-term capital gains rate, that is $10,050 in federal tax built into what Susan thought was a tax-free gift. Now consider what Susan could have done instead. Susan's taxable income in her early retirement years, before Social Security and required minimum distributions fully phase in, may qualify her for the 0% long-term capital gains rate. In 2026, single filers with taxable income up to $49,450 pay zero federal capital gains tax on long-term gains. For married couples filing jointly, the threshold is $98,900. If Susan falls within that bracket, she could sell the stock herself, pay zero federal capital gains tax, and give her daughter $85,000 in cash with no embedded tax liability. Same asset. Same intention. Entirely different tax outcome depending on who sells and when. The 0% capital gains window is one of the most powerful and underused strategies available to retirees. It requires knowing your income in the year of the sale. But for retirees who qualify, it eliminates the embedded gain, removes the carryover basis problem for the recipient, and in cases where the gifts are made in earlier years, can reduce exposure to the Medicaid look-back window over time. If this video is showing your family something it has never discussed before, hit the like button right now and share this with anyone you know who is thinking about giving money or property to their children. They need to see this before they act. Subscribe and turn on the bell so you never miss a video like this one. Now let me explain the stepped-up basis rule completely, because it is one of the most valuable protections in the entire tax code for middle-class retirees, and it disappears the moment you give an appreciated asset away during your lifetime. Under IRC Section 1014, confirmed and intact in 2026 under current law, when you pass away and leave an appreciated asset to an heir through your estate, the cost basis of that asset resets to its fair market value on the date of your death. This is called the step-up in basis. The practical effect is enormous. If you bought stock for $15,000 30 years ago and it is worth $280,000 today, and you leave it to your child at death, your child's cost basis in that stock is $280,000. If your child sells it immediately after inheriting it, they owe zero capital gains tax. The $265,000 in appreciation that built up over your lifetime is wiped out for tax purposes at the moment of inheritance. Now consider what happens if instead of leaving that stock to your child at death, you give it to them as a gift today. Your child receives the stock with your original cost basis of $15,000. If they sell it for $280,000, they owe capital gains tax on $265,000. At a 15% federal rate, that is $39,750 in federal tax. At 20% for higher earners, it is $53,000 plus state taxes in most states. You intended to give a gift worth $280,000. You gave a gift with a tax bill embedded inside it that your child may not discover until the moment they try to use it. The rule is clear and the math is straightforward. Giving an appreciated asset during your lifetime transfers the built-in gain to your recipient as a future tax liability. Leaving the same asset through your estate at death eliminates that gain entirely. For retirees with appreciated stock, appreciated real estate, or long-held investment accounts, the step-up in basis at death is frequently worth more than any benefit from lifetime gifting. Cash gifts do not carry this problem. If you give your child $19,000 in cash, there is no basis issue. Cash is cash. The issue arises specifically when retirees give property, stock, real estate, or any asset that has grown in value since the original purchase. One more trap deserves its own section because it affects retirees who fund gifts using IRA distributions and do not realize they have added a tax layer to the gift itself. When you take a distribution from a traditional IRA and give the cash to a child, two things happen simultaneously. First, the full amount of the withdrawal is ordinary income to you in the year it is taken. If you pull $50,000 from your IRA to give to your child, you owe income tax on $50,000 at your rate. The child owes nothing on receiving the gift, but you paid the tax to deliver it. Second, that $50,000 withdrawal may push your modified adjusted gross income over the IRMI threshold for Medicare, triggering higher Part B and Part D premiums 2 years later. It may increase the taxable portion of your Social Security benefits. And the gift itself is still a transfer that Medicaid will review if it occurred within the 5-year look-back window. Retirees who fund large gifts by taking IRA distributions are paying income tax on the transfer, potentially triggering Medicare surcharges and still creating a Medicaid look-back issue. They believe they are being responsible by giving from their own savings. They do not realize the funding source creates a second set of consequences layered on top of the gifting consequences. In many cases, giving cash from a taxable savings account or brokerage account where the withdrawal itself does not generate a new taxable event is a more efficient approach than funding gifts from pre-tax retirement accounts that add income to the return with every dollar withdrawn. Here is your action checklist. 5 specific steps based on everything you just heard. Step 1. If you are currently making annual gifts to children or grandchildren, verify that those gifts are not creating a Medicaid look-back issue. If there is any possibility you could need long-term care within the next 5 years and at 65 or older the statistics say most people eventually will, speak with an elder law attorney before making any additional gifts. The look-back window is running whether you are aware of it or not, and it started the moment each gift was made. Step 2. Never give a highly appreciated asset to a child or grandchild during your lifetime if you have the option to leave it through your estate instead. This applies to stock, real estate, business interests, and any long-held investment that has grown significantly in value. Calculate the embedded gain before you transfer anything. Subtract your original cost basis from the current fair market value. That difference is the future tax bill you are handing to your recipient. In most cases, the step-up in basis at death makes holding the asset until death far more valuable than giving it away today. Step 3. If you want to help a child with education or medical costs, use the 2 unlimited IRS exclusions that bypass the annual limit entirely. Direct tuition payments made directly to a qualifying educational institution and direct medical payments made directly to a healthcare provider are excluded from gift tax with no dollar cap and require no Form 709. Talk to an elder law attorney about how your state treats these payments under Medicaid rules before assuming they are fully protected in every circumstance. Step 4. If your estate is below the $15 million federal exemption in 2026, and for most retirees it is, the urgency to reduce your estate through lifetime gifting is low. The step-up in basis benefit of holding appreciated assets until death is likely worth more than any estate reduction benefit from giving them away. This calculation changes if your state imposes its own estate tax with a lower exemption threshold. Several states have state-level estate taxes that apply well below the federal limit. Know your state's rules before assuming the federal numbers are the only ones that apply to you. Step 5. If you have already made gifts within the past 5 years and you are at an age where long-term care may become relevant, consult an elder law attorney immediately. Tools like a Medicaid Asset Protection Trust may be available to help protect remaining assets, but these strategies require the trust to be funded more than 5 years before a Medicaid application to receive full protection. The sooner you begin, the more options remain on the table. Waiting until a health crisis has already occurred eliminates most of the planning options entirely. Here's what this all comes down to. The IRS $19,000 rule is real. The annual exclusion is legitimate and legal. The $15 million lifetime exemption is real. The step-up in basis at death under IRC Section 1014 is one of the most valuable provisions in the tax code for everyday American families with appreciated assets. These are good rules. The problem is not the rules. The problem is the assumption that the IRS rules are the only rules. Medicaid operates under a completely separate framework. Capital gains tax operates under a completely separate framework. State-level estate taxes operate under a completely separate framework, and almost none of these frameworks are explained together in a single conversation before a retiree makes a decision they cannot take back. Margaret gave her daughter a check, transferred stock, and signed over a deed because she wanted to help the person she loves most. She broke no IRS rule. She owed no gift tax. She did everything her accountant said was fine. She is in a nursing home with a Medicaid penalty period counting down because she did not know about a 60-month look-back rule in a program she had never thought about. Patricia gave her grandchildren Christmas money for 6 years because she wanted to be generous with the people who mattered most to her. Medicaid reviewed every one of those transactions and calculated a penalty from the total. Gerald gave his son a property worth $310,000 and unknowingly handed him a capital gains tax bill and triggered a Medicaid disqualification in the same transaction. These are not wealthy families making sophisticated mistakes. These are ordinary retirees doing ordinary things with money they earned, saved, and intended to share with the people they love. The rules that penalize them are real, enforced, and almost never explained in advance. This is Kevin with Kevin Retirement Strategy. If this video showed you something your family needs to know before anyone transfers another dollar or another asset to any family member, share it right now. The decision to give is irreversible in most cases. The knowledge needs to come first. Tell me in the comments, did your family know the IRS gift rules and the Medicaid look-back rules were completely separate systems? I read every single comment, and the most common situations become future videos. This is Kevin Retirement Strategy.